Hey, welcome to another video and thanks for clicking on this one. Let me turn down this volume of this a little bit. Trying to get the music in there, but hopefully it's coming out right. One of the things that I want to cover in this video is something that I've read over time, and it's helped me to understand a lot about investing, especially when you are thinking about a long-term, repeatable, and something that you can depend on in terms of knowledge, in terms of actions you can take, in terms of just how successful this has been for so many people. So the goal is that if you can listen, if you can apply these concepts and apply them well, diligently, chances are you would achieve success. I mean, the goal here is that we work, but we don't also want to keep working forever. The goal is to, at some point, take whatever we earn and let it work for us. And the truth is, yes, money is not everything, but money is also important. One of the things they say is that, you know, it's better to, how is it said? I think the saying is it's better to cry in a Lamborghini than to cry in a bicycle, something like that. But without wasting time, if you're new here, welcome. If you're a returning subscriber, thanks for clicking on this video. It's a late night one. I thought, you know what? I haven't done this at this time before. Let me give it a shot. Let me try it. Let's see what happens. And of course, if you're tuning in, do not forget to drop a like. Do not forget to subscribe to the channel. Engage. It would go a long way. Now, what I'm going to share with you tonight is really, this is a white paper that was written in 2013. And this is something, like I said, is something that I have looked over on occasion to remind myself of why I'm making a decision on certain, you know, maybe investment, or why I'm choosing to do something, even though the crowd might be doing the opposite. And, you know, I want to share that with everyone here because it's helped me. So let me pull that up right here. So what you have here, this is from Partners Capital, and you know, you can read more about the company itself, but you know, this was written by the chairman, founder of the company, and there's some lessons here that if you can apply, okay, to your own investment style, to your own toolbox, if you can add it to some of the things that you are already doing, especially if you're new to investing and you want to make sure that you're doing things correctly, then some of the lessons here would help. Now, we know that the stock market is recently, I'm talking about as of last week, made new highs, and we are seeing the trend, you know, kind of slowing down now because of these tariffs, and there's a lot of uncertainties in the market. We know that, but we have to always disregard the noise and focus on what is important. At the end of the day, the stock market has been around for so long that it's become something that like literally everybody depends on. When I say everybody, I'm talking about majority of investors. There's no person, even as a retiree, somebody who is retired, still needs to depend to have some stocks in their portfolio, to keep investing, to make sure that they can continue to see some growth in their portfolio. Otherwise, what will happen is, if you stay out of the stock market completely in terms of investing in equities, what would happen is that you would be most likely touching the principal that is laying the eggs for you. All right, and we don't want that. We want the principal to continue to increase so that the interest we make or earn continues to increase. Let me change this real quick here. All right. So, well, the first thing that I want to share here is one of the lessons that you need to understand is that you have to know and understand that there's no return without risk. And one of the things that it says here is, the first and most important principle of investing, which is right here, and do that, is that returns are only earned by taking risk. Risk is defined as the chance that you lose some or all of your capital invested. This loss can be a decrease in valuation of assets held, or it can be a permanent loss which has been realized by having sold the asset below its purchase cost. An ideal investment strategy would be to get a return without taking any risk of decline, but this simply does not exist. And it goes on to talk about a lot more. But the point that I'm trying to emphasize to you here, as the first one here, okay, would be to understand that there is no return without taking risk. And one of the things that scares a lot of people from investing from the get-go is the fact that, there's the fear of losing money. Right? Nobody wants to lose money. We don't want to lose money. You don't want to lose money. But you have to understand that your money in a savings account is also losing money. Okay. The fact that inflation is around, 2 point something percent now means that every year or every month that goes by, every day that goes by, your money is losing some of it to inflation. Things are getting more expensive. And as long that continues to persist, the fact remains that you will continue to lose some money to inflation. And the problem that we then see now is, if you're somebody who is so worried about losing money, then you don't want to invest in, let's say, stocks. In the stocks, you don't want to invest in stocks. You don't want to. All you want to do is save your money, and because it feels good to have this, see the number grow. But the fact remains, okay, that and I think there's something that I want to point out here. Okay. A third type of investment risk is interest rate or duration risk. The best example of this is government bonds or bank deposits. Before the recent global financial crisis, a US, Japanese, or Portuguese government bond was viewed as very safe with no risk that you would not be paid. So there was no credit risk or a reward that has to be paid to the holder of the government bonds for the risk of default. Okay. Let me see. So what is the risk that the government is paying for when it paid 4% for 10-year bonds and 1% for a 3-month bond? In the case of a 10-year maturing bond, it must pay the investor more than 3-month bond. There was a part that I'm trying to find here. I already mentioned the inflation factor. Let's see. And this goes on to talk about, when we have the situation we have right now with the Fed also adjusting interest rates as necessary to accommodate, or at least to adjust for inflation and counter inflation and bring inflation down. Whether you choose to invest in bonds, government bonds, corporate bonds, all that, right? Your chances of being able to outpace, all right, this interest you get on those bonds because of inflation is slim, right? The point here being, the place you still want to be, at least have some exposure so that your returns, okay, are somewhat reasonable, will be to still hold some equities or some stocks. Because even if you have your money in savings accounts, if you have your money in bonds, if you have money in CDs, The problem is that those may return some decent, they may have some decent interest rates, but you have to understand that interest rates continues to change. Most of the banks out there often adjust based on predictions of what is happening in the economy. So if they believe that, for example, the Feds will drop interest rates in the near term, they are likely to reduce their interest that they pay on whatever amount you have with them. Taking risk is part of this, and understanding that you can lose money is also part of this. Okay, so what can you do? It's important to understand that whatever money you're putting into a type of investment should be money that you're willing to part away with for some time. Understanding that this is a long-term thing. This is not something that you do on a short-term basis. It's not something that you want to take. You don't want to take your money out tomorrow, because what will happen is that will lead to a situation in which you end up selling at a loss. Okay, and that's not what you really want to do. Now, there are times where you have to sell at a loss. Okay, tax loss harvesting. That's one. Tax loss harvesting. That's, that is something completely different from what I'm talking about tonight. But understand that the goal is to hold some of this for the long term. All right. The next one here is economic cycles and risk. All right. It says economies rise and fall quite moderately. Companies see their profits fluctuate considerably more because of their operating and financial leverage, but stock market gyrations make the fluctuations in company profits look mild. Securities price rise and fall much more than profits, introducing considerable investment risk. Why is that so? Primarily, I think because of the dramatic ups and downs in investor psychology. Okay. And the important conclusions from observing the above pattern are this: over time, conditions in the real world, the economy and business, cycle from better to worse and back again. Investor psychology responds when things are going well. Investors swing to excessive euphoria under the assumption that everything will continue, right? And when things are bad, they swing to the opposite. All of this is all the economic cycles. And it says, while buying in bad times and selling in good times is logical action, if you believe that investor psychology drives prices beyond fair value, holding an investment through a full cycle may be easier to execute emotionally. Zero-sum investment world. Sadly, most investment activity does not add value to the world. As such, the actions of any one investor only serve to give capital to other investors through their loss-making investment or taking capital away from other investors. In other words, investing is a zero-sum game. The smartest investors take value away from the less smart. Okay, the psychology of investors describes the less smart investors. In the world of public securities, stocks and bonds, price movements are most dramatic when investors panic most. The panic can be panic buying in fear of missing gains, or panic selling when there is a fear of losing large amounts of money quickly. Panics happen fast in both directions. On these days of market panic, prices move the most. Okay, in a panic upward rally, the panic buyers are generally paying above intrinsic value and buying from the less panicked sellers who see the prices being paid above their true value. The implication is simply to never panic, to remember that when others panic, it is time for calm heads to take value from other investors. Now, the importance of this section is seen especially in the past couple of weeks, where the Liberation Day on April, I believe it was April, right? April 2nd, when the president announced the Liberation Day, the old tariffs thing started. There was a huge sell-off, right? And people sold, and of course we've risen in terms of the stock market has risen beyond the levels prior to the Liberation Day announcement. So literally, if you had held prior to that time, you are probably most likely in the green now. And of course, if you bought more shares when it went down, you're well in the green. Why? Because you did the opposite of what everybody's doing. And that is one of the reasons why, if you are somebody who is investing for the long term, all right, the goal should always be to maintain some calm, all right, and some level head in these times of panic, where Either people are panic selling or panic buying. You don't want to be in a situation where you're panic selling, especially, right? Buying too can be bad, and I've done a fair share of that in the past, where you see a price going up, you think it's going to keep going up because, hey, it's been going up, so let me jump in, right? You jump in, and of course it goes the opposite way. Permanent declines, temporary paper losses versus temporary paper losses. A loss is a difference between what you paid for an investment and what is worth today. Market prices and non-market prices on formulas or third-party. Let's see. Permanent losses are those which have been fully realized through sale, liquidation, or termination. Such losses have been realized and are not coming back. The job of the intelligent investor is to avoid permanent losses. That's exactly what I was saying. And to accept temporary paper losses. Most investments are subject to the prospect of permanent loss. Those that are not subject to complete permanent loss are thought to be government bonds, assets such as land, natural resources, or commodities. Virtually all other investments are subject to permanent loss. The primary contributing characteristics of investments most subject to permanent loss are the following: anything leveraged with debt, right? The value of the underlying asset falls below the value of the debt, and the debt is defaulted on, and the asset is taken away from you and given to the lender. So like properties, homes, things like that. Let's see. The implication here is not that investors should avoid anything that can result in permanent losses, but rather that they should demand higher returns for taking that risk. All right. The other important implication is that temporary losses that appear to be the result of prices falling below intrinsic value should be viewed as relatively unimportant to the true long-term investor. Okay. We cannot avoid accounting for and reporting unrealized temporary losses, but to the extent that they are in fact temporary, they are irrelevant to the true long-term investor. The most practical implication of this is that if the presence of temporary losses is accepted as normal, one can take higher levels of exposure to an asset class such as public equities that might be indicated if one is more concerned about monthly or annual declines. Let me see. One of the key things to realize is a lot of times when people buy into certain stocks or even anything, right? For the purpose of investing, for the purpose of making gains, one of the things that you want to keep in mind is, for the risk you're taking, what is your return? The more risk you take, the more your returns should be. And this may apply to, I would say, people who maybe try to day trade or swing trade, where you believe that, well, if I'm buying like X amount of money, what is my return? Like the best way to describe is this, is it 2 to 1, right? Or is my goal is to double my returns of the investment. So if I'm investing 1,000, my goal is to make 2,000. All right. So if the risk is high, then I should make sure that my returns is worth the risk. Okay. So it's a 3 to 1, where you're trying to invest 1,000, but your goal is to, because of maybe the type of asset it is, your goal is to make 3 times what you invest. But that also comes with a little bit of bias, right? Because it all depends on how you view the asset or how you view the investment or the stock of the company. And this is why one of the key things that you want to look for is, again, what it's mentioned here, all right? And it's on this side here. The other important implication is that temporary losses that appear to be the result of prices falling below intrinsic value should be viewed as relatively unimportant to the true long-term investor, because at the end of the day, if you're a long-term investor, you don't have to worry about a stock falling because at the end of the day, it's actually presenting an opportunity for you to buy it at a cheaper price. And that is really what I'm guessing that's what people do especially when they say they're buying the dip, right? You're buying the dip because you believe that it's below its intrinsic value. It's below the true value of the company, and you see more opportunities, at least more upside to the stock that you're buying. The fourth one here is a common measure of investment risk, standard deviation of returns. And since standard deviation is exactly a standard or normal variation in outcomes in the investment world, this is a measure that quantifies the normal variation or dispersion from the expected investment return. The riskier the asset, the more dispersed will be the range of normal return outcomes around the expected long-term average. Higher risk assets have a higher standard deviation of returns, which makes sense. A low standard deviation reflects potential outcomes being more closely grouped around the expected returns or safer assets. In investing, standard deviations are usually referring to an annual standard deviation around average annual returns or mean returns, but the same tool can be applied to deviations of returns covering any period of time. And this is kind of just going into the statistics between a certain period. And here it says risk is better measured in terms of a portfolio's value movement in relation to the market's value. The relationship is measured by the factor that captures the proportion of portfolio value change, the percentage of market value change. This factor is referred to as the beta. And this is, where can I pull that up actually? There's a page, if you go to a particular, actually, let me see if I can pull this up here. If I pull up a particular stock of a company, let's see. Usually they always have the better right here. That is the better for better. I think that's how it's pronounced. Anyway, it's 1.2, and then if you pull it, let's say we pull up for, let's say, Nvidia, for example. So Apple is 1.2. You can see this one is 2.1. Now, generally, this also indicates how volatile, right? This is twice, okay, in comparison to that of Apple. And let's find, for example, Coca-Cola. That should KO. You can see this one is 0.46. The point here is the lower this number, the more stable it is, if you think about it that way. Whereas the higher that number, the more volatile it is. A good example would be Tesla. Let me pull up Tesla now. Tesla is 2.46. All right. I think that's the highest that I've seen so far. The higher the number, the more volatile the stock is, which means that, you can see extreme swings on either the upside or the downside. Now, this can be good for people who trade options. If you're somebody who trades options on a regular basis, having some high of volatility, or some level of volatility can help push you in either direction, which, depending on how much risk you can tolerate, right? That puts you in a position where, and here's something I need to mention, right? This is speaking in isolation of, or at least if you pick individual stocks, okay, and you're investing in individual stocks, if your portfolio holds companies that have very high beta or beat better, I think that's how it's said, what happens is that your portfolio fluctuates extremely, right? Especially on good days, you see very high returns. On bad days, you see very drastic drops in your portfolio. On the other hand, if you have low beta portfolio, what happens is that your returns will also be somewhat not as volatile, will be somewhat stable. Anyway, back to this here. All right, the goal here is, it says, look at this. It says, for example, a portfolio with a beta of equity market of 0.6 can be expected to rise 6% when equity markets have gone up 10% in a period. The market beta of each asset or fund in a portfolio can simply be summed up across the portfolio to give an excellent measure of an overall portfolio risk or exposure. By tracking the underlying fund and asset betas each month, we can always know the portfolio's overall risk level and use this information to regularly rebalance. And that was in relation to what I was saying, that if you have a group of companies in your portfolio with high betas, like let's say 2 and above, for example, what happens is that you see a lot of extreme movement, and that can be something that is good for people that are young, right? You have a lot of time horizon, you want to take as much risk. But if you're somebody who's let's say your risk tolerance is of moderate or low, and you have your portfolio consists of companies with 2.0 and above better, or even 1.5 and above, right? You start to approach a high level of fluctuations, or experience a high level of fluctuations in your portfolio, which might not be something suitable for you. All right, the fifth lesson here that you need to keep in mind, and the key thing here for this, all this common measure of investment return, investment risk, what you want to take away from here is you want to make sure that as you build your portfolio, as you choose your investments, in as much as you may not really consider what I just showed to you, the beta of each company, right? You may not really look at that. It is something to understand, because if you choose extremely volatile stocks, you will see extreme swings, which may not be favorable to you. All right. And the other thing also is, talking about rebalance. I think this is important to talk about also. There are times when, these high beta stocks tend to perform, generally speaking, really well. And if they've performed really well, what happens is you end up having a situation where most of your gains are concentrated in one particular stock. Hence the reason why you should think about rebalancing when you've seen, maybe 10% or more, depending on what number that works for you. If you've seen 10% or more gains in your portfolio, it might be time for you to rebalance. All right. And that's something that you always want to keep in mind. All right. Next one is the benefits of diversification. The range of possible returns from one investment are much broader than the range of possible returns from a larger number of investments. Break it down, right? If the range of possible returns from one investment rather, are much broader than the range of possible returns from a large number of investments, especially if the number of investments returns are determined by different things. The essence of diversification is about holding sufficient number of different investments whose returns are influenced by different factors. You can see, so for example, what this is showing here is you have expected standard deviation, and then you have number of holdings. Look at this as the risk, right? So the higher the risk, if you have just one stock, of course, you get that equivalent of that risk, right? So this is one, right, or one company, for example, right? If you have only one company, you have the highest level of risk in that portfolio. But as you diversify, as you add more assets into that portfolio, your risk level decreases. Now, there's also something to understand. When you have a lot of holdings, a lot of companies held in a portfolio, what ends up also happening is that there's a chance that yes, your risk level is reduced, as you can see here. Okay, with more holdings, you have lower risk, but your returns is also impacted. But here's what a lot of people then fail to understand. When you have a long-term plan, right, if you can consistently make 8%, 9%, 10%, right, every year, or maybe 6% every year for most of it, right, then you will be successful in terms of reaching your maybe financial goals. Your ability to repeat this thing is what we are depending on with time, right, with compound interest working in our favor. So rather than taking an extreme level of risk, right, assuming that we only have one stock and we put all our money in that stock, guess what? Yes, our returns can be very high because our risk is so high. But what happens the following year? Because guess what? Every stock will not continue to go up forever. So we need to have that understanding that yes, I may be highly concentrated in one particular stock, right? And it may seem really good when things are going well, but we also have to remember that this cannot continue forever. So rather than putting ourselves in a situation where we have extreme concentration in one particular stock because of the returns we want to get, why don't we fall in a range where we are diversified, but we can consistently be in the green and make gains? And if we can just repeat that and we stay in the green, we're not heavily concentrated on one particular area, well, that is repeatable because we are not trying to bet on one stock to help us to the goal we're trying to achieve. Right here it says multi-asset class diversification is the best thought of by first considering equities and government bonds. These two assets typically move in opposite directions. Now, this is something that I am not sure I truly agree with. It does for most part, okay? But recently we've also seen that bonds hasn't really performed well, and it hasn't really moved opposite of how equities move. But again, there's been a lot of anomalies with COVID happening, interest rates rising, and of course printing more money, right, with inflation. So all of that might be what's impacting the recent correlation in these two asset types. But at the end of the day, whether you choose to diversify with stocks of different companies or you diversify between equities and bonds and maybe real estate, understanding the risk that comes with them and why you need to diversify is key, especially as somebody who might be new to investing. And this is an example of a well diversified portfolio. For example, if you are extremely focused on or extremely concentrated on commodities, this is where you would be, right, in terms of the standard deviation and expected rate of return, right? But as you have a mix of all of this, cash, government bonds, now you decrease your risk level as well, and of course your expected rate of return also decreases. So if you're full in cash, of course your risk is low, but also your return is low. Of course, as you move out to these regions here, your risk is higher, but at the same time, it says the blue line is above is known as the efficient frontier and defines the return achieved from the optimal mix of asset classes for any given level of risk. Standard deviation. All right, so if the investor would like to limit the annual standard deviation to say 10%, the most optimal mix of asset classes at the risk level would be expected to generate a 9% return on average. This is because the classes are not highly correlated with one another, and the combining of assets always generates more return for the same risk. This is often referred to as the free lunch from multi-asset class diversification. The investor gets more return for the same risk level of a single asset class. This tool is used by most portfolio managers to construct the optimal multi-class asset portfolio and was designed initially by Professor Markowitz. The obvious limitation of this model are the accuracy of the inputs, which are future estimates of asset class return, standard deviation, and cross asset correlation. Evidence of the one of the things that I see here, I think the most important thing that I see here is understanding the level of understanding, your diversification, why it's important to diversify investment, and also understanding how these assets work together, right, is important. And different assets, classes that you have here would often work in depending on the environment you find yourself. Let me change something here. Let me change that. All right, next one here. I'm just going to move to this one. Let's say the long-term investors' advantages. Long-term investors' advantages over short-term investors. Sadly, investing as an activity on its own generally does not add value to the world. One of the important things that I see is that if you are, considering investing on, a lot of times people would choose to either want to invest for specific reasons. And, short term is considered anything less than 3 years. Long term is considered anything more than that, generally speaking. Now, if you are trying to invest, for the long term, then one of the things that you want to see, and here it actually says 5 years. Let's see. Actually, let me see what it says here. The vast majority of investors in the world are professionals who are paid to win at investing, and they care hugely about their short-term earnings, not their long-term earnings. They want bonuses this year, not 5 or 10 years from now. They have mortgages and school fees to pay today. The personal investors are equally short-term in their thinking. They are mostly unsophisticated investors who judge themselves on what worked this week, month, or maybe year. They struggle to think long-term or longer term. So the battlefield where perhaps 90% of the investment world is competing to gain a share of the pie is very short term. For that reason alone, a wise investor would focus on the long term. It is just less competitive. Very few people are investing 4, 5, or 10-year horizons. So it should just be easier. It should just be easier to win on that battlefield. And who are the losers in the long-term battle? The short-term investor. The basic rule of outperformance in investing is that long-term investors take from short-term investors. This is how it works in practice. In any one calendar year, you will have noticed that the majority of the big market price moves that add up to the full year's performance happen on a small number of days during the year. In an extreme performing years, the majority of the price movement happens in a small series of sequential days where there is a panic driving prices up or a panic driving prices up. Okay. This is human nature. Who are the buyers who are selling during these few important days? The sellers in panic are the short-term investors who care hugely about the year's bonus or performance review with their boss, or the entrepreneur who worked very hard to make the money he just doesn't want to lose. Right? Another reason the long-term investor wins over the short-term investor is because long-term outcomes are often easier to be right about than short-term ones. Will Apple win the tablet war? Is a long-term question. It is far from 100% certain, but perhaps 70% certain. Will Apple have a positive surprise in quarterly earnings? Will iPhone 5 sell as many phones this Christmas as expected? These are difficult short-term questions that short-term investors love to bet on. The odds are very close to 50% of being right. All of this again goes back to understanding that it's hard to beat the market. It's very hard. You have a situation where a lot of people are, betting on, weekly performance of a company. A lot of people are betting on the weekly performance of a company, and nobody knows what the future holds, right? Nobody can tell what will happen in the near term, based on just the fact that a lot of things are going on in the world, right? You have a lot of unforeseen circumstances, a lot of situations that are unpredictable. So it's often best to stick to that long-term approach and think of it this way, right? The fact that we can't see, one thing that we can always count on is the stock market itself. The stock market has performed really well over the years, and history repeats itself, like they say, right? Yes, there'll be times when there'll be some downturns, there'll be market crashes, there'll be unpredicted situations, but generally speaking, the stock market recovers, makes new highs, things turn out to be good again. On the other hand, with short-term investors, where you're thinking things would turn around, let's say a month or 2 months, right? What if you're wrong? Then that money, you end up losing that money because you cannot hold, or you cannot bear the loss temporarily anyway. It says here, who can be long-term investor? Most individual investors need the money to live on, so must be short-term investors. They cannot take the chance of not having the money fully liquid and available to them in case they need it. That defines the situation and mindset of the losing investor, who generally donate their underperformance to the long-term investor, who calls it out performance. Okay, many asset managers are also short-term, as their individual and institutional investors can ask for their money back any day or within a month or quarter for the long-term fund structures. So they have to invest for the short term. Hence, most liquid active asset managers underperform their own indices as the long-term investor take performance from them. Endowments, foundations, and pension funds are most able to be true long-term investors, as there can really be a surprise event that requires them to liquidate investments. Foundations with 5% spending rules can lock up 95% beyond 1 year or 65% beyond 7 years, theoretically. For school endowment, it depends on how dependent the school is on the endowment for meeting operating and capital expenditures. But most have 4% annual spending, which points to situations not dissimilar to foundations. Pensions usually earmark liquid assets for near-term benefit payments, which are well known, and they lock up the rest for long-term investment. So not surprisingly, endowments, foundations, and pension funds as a group outperform high net worth investors and liquid asset managers as investors. But to take advantage of their unique status as long-term investors, they must invest like long-term investors, locking up capital and earning the so-called illiquidity premium available from investing with managers who invest for the long term, or into assets like private equity and property, which lock capital up for 7 to 12 years but return some of the most attractive returns across all asset classes. You know, again, this is just going back to the same stuff of thinking long term. If you don't touch the asset, if you don't touch the principal, right, or the you know, if your returns is, let's say, 7%, right, and you're only taking 4%, you still have 3% that helps to grow the portfolio plus whatever is there. All right, so this understanding this game means that you'll never run out of money in theory, right, unless something crazy happens. Market returns, beta versus manager excess returns, value added or alpha. So beta only take market risk through passive investment and get paid for it over the long term. Alpha arena, investing actively and taking a long-term perspective to maximize chances of winning, taking a large share of the investment pie. No investor has to play in the alpha arena and compete for a share of the pie. It's kind of interesting. It says, this is the way we always report client investment performance. Break the total portfolio return into beta return and alpha return. If beta alpha return is consistently 0 or negative, it is time to only play in the beta arena. Yeah, this is an interesting one. Market timing, right? One of the greatest things that they say is, you know, time in the market beats time in the market, right? So sadly, all too much of intelligent human are devoting their productive ingenuity to investing. Probably 5% or more of most developed economies are devoted to making markets more efficient by seeking to have insights others do not have. The result is that having an insight is very rare. Keeping in mind that 90% or more of this pool of human resource is focused on short-term investing. Single investment decision that most of the investment humanity are trying to get right is when to get in and when to get out of the financial markets. As a result of such intense focus on this one decision, so very few are able to get this right. We see the risk on or risk off decision as the single most difficult decision to get right. So we don't try and do not think our clients should either. All right. Keeping it level often has performance enhancing benefits. When risky assets decline in value, safe assets like government bonds usually increase in value. The result is that the portfolio's overall risk level declines. We will at a time rebalance client portfolios back to their risk target by selling safe assets and buying risky assets right after the risky asset market decline. This has the same effect as we discussed earlier. And this is just talking about the whole rebalancing of portfolio. But the key thing here is, you know, 6 things or 7 things, mostly 7 important things, all right, that needs to be covered here is there's no risk without return, right? There's no return without risk. Okay, so there's no risk without return. There's no return without risk. All right, that's important. The second thing is economic cycles and risk. Okay, that's a given. The economy will do its thing. Okay, and it's go through its cycles, and there's the risk that comes with that. All right, permanent declines versus temporary paper losses. One of the important things is to avoid permanent declines. Permanent decline, what is that referring to? Selling low, trying to get out of the market. All right, when maybe you're panicking or you feel like something terrible is going on, when in reality you can, if you take your emotions out of it, you're likely to do just fine in the short term or in the long term. Common measure of investment is standard deviation of returns. That is all about knowing the how a particular asset affects your portfolio. If you're buying all stocks, know that your portfolio would have more risk inherently. And of course, if you mix bonds or let's say dividend paying stocks, cash, then of course the risk starts to kind of decrease, right? Then you have diversification, which kind of goes in line with diversification. Then of course, long-term investors do better than short-term ones. Now, there are times when you might have good short-term returns, but in the long term, can you actually sustain those returns? That's a question you want to ask yourself, right? And of course, market returns versus manager excess returns, talks about the beta arena and alpha arena, and more for like pros at this, right? Of course, for the futility of market timing, understanding that we can't time the market, like it said in one of the paragraphs. And some of these years in which we've seen very strong returns, you sometimes only see the most return on specific days during that year, and if for any reason you're out of the market during that period, you would have missed out on those awesome returns. Just wanted to share this with you out there. Of course, if you found value in this one, don't forget to drop a like on it. Of course, I would love to see you in the future stream or live, and of course in the future video. Have a good night.